If you look at the national headlines right now, you see two movies playing on the same screen at the same time. On one hand, gross domestic product is growing at a robust 2%. Unemployment is sitting at a historically healthy 4.3%. The tech-heavy Nasdaq 100 just shattered previous ceiling to hit brand-new all-time highs, driven by massive capital spending on artificial intelligence infrastructure. By every traditional metric, we should be experiencing a euphoric blank check real estate market here in the Bay Area. But on another hand, inflation jumped to 3.8% in May. If you step out of the spreadsheet and walk into an open house, the reality is entirely different. Consumer confidence is completely fractured. Buyers are spooked, sellers are confused, and the market is showing undeniable signs of fatigue. Welcome to the Silicon Valley housing market of June 2026. Today, I'm going to break down the latest May data for San Mateo and Santa Clara counties. We're going to expose exactly why local home prices are actually dropping while the stock market is surging, and why the approaching summer slowdown is about to create a massive trap for unprepared sellers and a rare golden opportunity for motivated buyers. If you are buying or selling in this market, you cannot afford to misread this shift. To understand the bizarre psychology on the ground, we have to look at the microeconomic whiplash defining this month. On one side of the equation, the wealth effect is staggering. S&P 500 companies just posted their sixth consecutive quarter of double-digit earning growth. The hyperscalers are deploying a record amount of capital into AI, which directly enriches the stock-based compensation of Silicon Valley's top tier. But on the other side of the equation, the cost of living is suffocating everyone else. Headline Consumer Price Index just came in at 3.8% year-over-year. That is the highest inflation reading we have seen in 3 years. Those stubbornly high prices forced the Federal Reserve to hold their benchmark rate steadily at 3.5 to 3.75%. Even worse, policymakers like Dallas Fed President Lori Logan are now openly warning that rates may actually need to rise later this year to combat the sticky inflation. Because of this, mortgage rates have stabilized in a painful band between 6.3 and 6.5%. This creates a severe disconnect. Tech workers might feel rich when they looked at their E-Trade accounts, but when they go to the gas pump or when they calculate monthly mortgage payments at 6.5%, that wealth illusion shatters. Combine that inflation anxiety with quiet, persistent rumors of industry layoffs and corporate restructuring, and you get a buyer pool that is highly defensive, deeply anxious, and completely unwilling to overpay. Let's look at exactly how this macroeconomic anxiety is showing up in our local markets here in Santa Clara and San Mateo counties. The median home sale price across all property types, single-family homes, townhomes, and condos, landed at $1,700,000. Pay very close attention to this next metric. That $1.7 million presents a 1.4% decrease month over month. More importantly, it is a 2.9% decrease compared to this exact same time last year. Let that sink. While the Nasdaq hit all-time highs, the median property value in the heart of Silicon Valley actually contracted by nearly 3% year over year. Sales volume is also reflecting this hesitation. We saw 1,633 homes change hands in May. While that is a 5% increase over the last year's completely frozen market, it is a 4.4% drop from the previous month. The spring selling season peaked early, and buyer demand is visibly rolling over. Active inventory ended the period with almost 3,400 homes available for purchase. This is virtually unchanged from last year, but it presents a 3.6% decrease from the prior month. We are not seeing a massive flood of new sellers. Instead, we're seeing a market that is simply running out of steam. We can see this exhaustion perfectly reflected in the days on market. For the homes that actually sold, the median time on the market ticked up to 12 days, compared to 10 days in the previous month. Now, 12 days is still historically fast. But in the microeconomic climate of Silicon Valley, a 20% increase in marketing time is a massive behavioral shift. It tells us that buyers are taking a break. They are scrutinizing disclosures a little longer. They are thinking twice before waiving all their contingencies. And remember that 12-day median only represents the homes that successfully sold. Many overpriced homes are sitting on the market much longer, effectively acting as a dead weight on the market. Zooming in from the spreadsheet to the street, the psychology at open houses right now is incredibly tense. We're approaching the end of the traditional spring selling season. Historically, the Bay Area market operates on a very strict calendar. Once the school year ends and summer vacations begin, foot traffic at open houses plummets. Families shift their attention from Zillow to summer travel, and the market generally enters a slow period until it rebounds right after Labor Day. Because of this seasonal shift, combined with the low consumer confidence driven by inflation and layoff rumors, we're seeing a severe conflict between the buyers and seller expectations. Sellers are looking at the stock market and expecting a bidding war. Buyers are looking at their gas and grocery bills and 6.5% interest rates, and they are refusing to subsidize a seller's delusion. This is exactly why the turnkey premium is stronger than ever, and the fixer-upper penalty is absolutely brutal. If you list a home that is perfectly remodeled and staged to look like a luxury hotel, you will still command multiple offers. Most buyers simply do not have liquid cash or emotional bandwidth to deal with contractors in a highly inflationary environment. But if your home needs a new roof, bathroom remodel, or foundation work, buyers are punishing you. They are aggressively discounting those properties because they view renovations as a massive financial liability right now. If you are a seller, this data is a massive wake-up call. The peak spring frenzy is officially behind us, and the summer market freeze is arriving early. My advice to you is this: if you must sell your home this summer, you cannot afford to be greedy. With the median price dropping year over year and foot traffic declining, you must price your home aggressively to induce a sense of urgency. The absolute worst thing you can do right now is test the market with an aspirational price. In Silicon Valley, the only way to extract top dollar is to strategically underprice your flawless home to trigger a bidding war. You want buyers fighting each other, not negotiating against you. If you overprice today, your home will sit on the market through June, July, and August. You will suffer the fixer-upper penalty, and you will eventually sell for a massive discount. If you are a buyer, do not let the scary macroeconomic headlines push you to the sidelines. The summer months are actually your golden window of opportunity. Because the casual buyers have paused their search to go on vacation, and the fearful buyers are paralyzed by inflation, your competition has fundamentally thinned out. Your hidden leverage right now lies in the homes that missed the spring rush. Look for the properties that have crossed the 20-day threshold. The sellers of those homes missed their window, and they are starting to panic. Do not just look at the current price. Look at the listing history. If a seller has been on the market for 30 days, as we had into July, they know they are facing a long, quiet summer. That is exactly where you strike. You leverage the lower summer competition to negotiate ruthlessly on price. Navigating a market that is slowing down, while the broader economy appears to be speeding up, requires incredibly precise strategy. You cannot rely on national news, and you certainly cannot rely on generic real estate algorithms to tell you what a home is actually worth in this specific microeconomic climate. Because Silicon Valley is currently operating as a deeply fractured market, your playbook must be hyper-tailored to your personal balance sheet, your equity position, and your specific lifestyle goals. Whether you are a seller trying to engineer a bidding war before the summer completely stalls out, or a buyer trying to extract maximum leverage from a fatigued seller, there is no cookie-cutter solution. We need to sit down and have a real unfiltered conversation about your exact needs, your preferences, and your risk tolerance. Reach out to me directly, let's connect, cut through the headline noise, and build a forensic data-driven strategy designed specifically for you. This is Michael Tallis with the Tallis team. Protect your wealth, and I will see you in the next update.